All right, folks, thank you for tuning in. We're going to be covering this Fed decision live with Jerome Powell about to be speaking here any minute now. Looking forward to breaking this one down with you guys. I'm going to put out the good word right now that we are live. Appreciate you guys for coming on in. All right, let's get this party started. So we did get the Fed decision, folks. It looks like they are going to be pausing, but the news as we pick apart kind of their expectations forecast, they are talking about keeping rates higher for longer, and they are planning on raising rates at least probably one more time this year. So the decision made today to not raise rates, but it looks like the decision going forward is that there's going to be one more this year, and that we're not going to get any cuts this year, and we're not going to get any cuts till later next year. And they still want to keep the effective funds rate pretty dang high, up near 5% effectively. And so this is the real estate reset. This is the markets coming back to reality that the Fed is, I gave him a little bit more credit. I thought he was going to do the interest rate raise today. He didn't. Jerome Powell giving us a pause, okay? So you guys better enjoy this brief moment while it lasts. But the market's understanding what's about to take place here, which is markets continuing, the rate's going to be elevated for longer. And that's going to be a painful deal for us to be going through. Now, right now, I am waiting for Jerome Powell to take the stand here. We got the video feed here, and there he is. Let's tune in on this, folks. Thank you for tuning in. Let's listen in.
Good afternoon, everyone. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we are in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace, and so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025.
So what that means, folks, is he ain't cut until next year.
Projections, the
right?
median projection is.
That means that we're going to raise it one more time this year, and then we're going to start to cut later next year. So those rates are going to be kept elevated. We're actually going to bump them up a little bit more. You're going to feel the pain, America, but your job numbers are doing fantastic. You guys are doing great out there. Let's let them finish.
Meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects.
So he basically just said, we want to see it moving back down. We don't need to achieve the 2% target. We just want to see it moving back down, right? So they just keep on kicking that goalpost out, right? Moving that goalpost, kicking the can down the road. Our target 2%. You're nowhere close. And I was giving him the benefit of the doubt that he was going to raise another 25 basis points this meeting, get it out of the way, right? And just raise now. Why wait till the next meeting? I think we have a couple more meetings to finish off this year. But once again, even he's admitting that they still haven't felt all the effects. They haven't been able to break down all the data and really compose the actions of the last 2.5, 3 years of craziness, opening up Pandora's box. We'll call it Powell's Pandora's box, right? And let's let Chairman Powell finish his statements here.
Economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Let's listen in and see if he gets any good questions or if they just softball him.
What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the two remaining.
Once again, why not just do it now? Get it over with, right? Rip the Band-Aid off. We have no chance of fighting inflation. Let's be honest with ourselves, right? Why are they so soft? Give us some discipline, right? And guys, I'll talk later. I don't really have time to get into the Fed, who's going to audit the Fed, should we end the Fed? You know how I feel about all that stuff. But this is the cards that we're dealt, right? This is the hand that we're dealt as we're dealing with this guy softball dancing around the questions here. Let's let him finish.
Meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that
what he means by that in simple terms, and this economic jargon that they use is just it's just nonsense. Let's just cut to the chase, right? We're talking about moving rates and we're talking about supply of money. What he's talking about is that the rates are effectively above inflation, right? So that's strong restrictive. We have rates that if you want to go borrow money, it's going to cost you more than the cost of inflation, right? That's what he's talking about right here, which that would be running with the assumptions of the government funny data, the CPI lie.
Of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that that's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance, and I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think, and you have some. You saw, I think, 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions, and really what people are saying is, let's see how the data come in. We want to see. What we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months. We want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. They want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it as we've gotten closer to it.
It's an absolute joke. I mean, can you imagine having a beer with this guy? Just trying to have a regular conversation over dinner, and this guy's just dancing around all the conversation, all the topics, right? Like, just give me a straight answer, right? This is painful to listen to. I apologize that this is how this guy talks and what we have to deal with here, but we're trying to understand, go into the mind of these private central bankers that make all the decisions that impact our country so massively, right? And we have to try to decode what Daddy Powell is going to do, whether he's going to take it easy on us, whether he's actually going to bring in some pain. and it's an absolute joke.
We've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates. We have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, we know it by its works. We only know it by its works, really. We can't. The models and that we use. You only know when you get there, and by the way the economy reacts. And again, that's another reason why we're moving carefully now, because there are lags here. So that it may.
Thanks for telling us absolutely nothing. Basically just admitting that you have no idea where we're going, and we're not going to know till we get there. Gee, thanks. Really appreciate that update. This is a joke, folks.
It may, of course, be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing.
Sorry, I got to stop them there. It's progress for them. It's pain, and it's a second and a third job for the American people. That's what the good unemployment, the good jobs, right? It's the second and third job for the average person. It's not a high paying job. It's not a job that you're going to be able to actually fulfill the American dream or, actually take care of your family. No, it's your second and third job that's filling and padding these numbers, which is progress for the suits. That's how they think about us, right? It's progress for the suits. It's good for the talking heads. They want to come on here and ease the conditions, make them feel better, Jerome. Meanwhile, you're going to your second and third job. Do you feel great doing that? No, you're doing it because you have to. You're doing whatever it takes for your family. That means second, third job, cutting back because you're paying over 20% for real groceries, real essentials. But meanwhile, he's talking about Fed, Target, and different forms. They got 6 different forms of inflation, right? They change how they track it every year. So what are we even talking about at this point, right? But progress for the suits is pain for Main Street. That's what this is.
To something different, would you call the soft landing now a baseline expectation?
Yeah, soft landing, yeah.
No.
Sure.
No. I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But
what are you talking about?
It's possible, and I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve.
Oh boy, here we go again.
Sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates. And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say, if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage we're at, though.
But it looks like because there was an across-the-board drop in the core PCE inflation projection for this year, and even then it seems possible the core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be
Yeah. That's enough. That's enough, folks. I mean, the guy's not even going to answer us straight. He's not going to give us anything to work with, right? We can dissect the notes that they had from their meeting and kind of understand what's taking place. And we know what has to be done if we actually want to fight inflation. The trillion-dollar question is whether or not they're actually going to do what it takes. And it appears that they don't know themselves, right? Because, like I said, they opened up Powell's Pandora's box in 2020. They inflated a third of our country's currency, right? And they printed more money than they could even keep track of. And they're still doing that, right? And so when Powell's telling us that they don't know where they're going, it's because they really don't, right? They set off a financial bomb, and it's just a matter of seeing how far the contagion's going to spread, i.e. massive money printing inflation. And now when we run the surveys, over half of millennials and people that have student loan debt say that they're not going to pay if they have to pay once again on student loan debt. And then now we're starting to see all these, folks running out of the PPP money, all the different loans. There's a lot of people that are getting scammed right now with the employee retention credit. That is kind of deal, but now they've been backlogged for a year on the employee retention credit. It's just a mess that they've created. And so to me, the big takeaway is that they don't know what they've done, right? They don't know, as they unwind this thing that they've created, they don't know where it goes. It's very clear. It's very simple. And what they do know is that they haven't done enough, and that's why they're leaving one more interest rate hike on the table, right? They're giving themselves plenty of room to breathe, plenty of room to make that additional rate hike. So that's going to be critical because that's going to raise that Fed funds rate even more, which is going to raise your mortgage, which, as he alluded to, households and business credit crunch is already here. Folks cannot get new credit. Nobody wants to sign on to an 8% mortgage, right? And what this is going to do is going to allow them to keep on issuing new bonds with those higher returns. As we've seen the 2-year Treasury go up above 5, we've seen the 10-year well above 4, and these are levels that we haven't seen since 2006, 2007. And what this does is it's going to bring more pain to the middle class. It's going to bring more pain to the markets, right? But it's not going to be enough to curb inflation. So we have basically either death by inflation, right? Or we start to have raise rates and death by a crashing economy. It's death either way, though, right? We either die because we don't raise rates high enough to curb inflation, and so we're going to have runaway inflation, have folks continue to lose the value of their dollar, but the asset prices are going to continue going up. Your stocks will pump. Maybe, Bitcoin's going to keep on going up a little bit, right? And if they do what it takes to curb inflation and they raise rates, it kills the economy. So pick your poison is where we're at. And that's why Jerome Powell has to do his little dance up there. Now, I want to go through the notes that I took from that painful speech there from Jerome Powell. Let's listen in on this. He says that they understand the hardship that Americans are feeling right now. Let me know in the comments down below if you feel like Jerome Powell understands the hardship of the American people. Price stability. Once again, he's given about half a dozen talking points, maybe not even that many, 4 talking points. And every single question that he's getting from the press, he just brings it back to those 4 talking points, right? Reducing their balance sheet, we understand that. And then once again, he says the effects haven't been felt. As I said, they opened up Powell's Pandora's box. We're still figuring out what we've created here. Fixed investment hurt. That's the bonds. And that's the hundreds of billions of unrealized losses on the bonds that folks have, loaded up on. 2.1% GDP to finish off this year, and then growth to cool next year, but they expect the median to be 1.5% next year. So we won't go into a recession. They are not predicting a recession, okay? But we are going to be contracting from these levels or restricting our growth. Let me know in the comments down below if you feel like our economy is growing, right? We're at the 2.1% GDP is the expectations to finish off this year, down to 1.5%. That's an absolute joke. Let me know in the comments down below if you feel like our economy is actually growing right now. Good jobs numbers will ease inflation. I already mentioned it. It's an absolute joke. Folks are going to get their second and third job. How does that ease inflation? No, it's just folks are doing whatever it takes to feed their families. That's why we have good job numbers, and that is not going to ease inflation at all. More people making money, then that means that there's more money to be spent. Why would that ease inflation? If more people have money to spend because they're working, then they're going to be able to pay the higher cost of food, energy, essentials. They're being forced to. So, like I said, good job numbers to him. Progress for the suits is paying for Main Street. I like that one. I'm gonna hang on to that one. Progress for the suits is paying for Main Street. Maximum employment and stable prices. How many times did we hear him say it? We understand it. You don't need to repeat it again and again. It's an absolute joke. Household and business credit crunch. As I said, this is where the pain is being felt. When you go to keep your business running, to make sure that we're going to cash flow through this recession. If you need to go get some debt, you'll go get some credit, right? You're having to pay twice as much. Your debt service cost is twice as what it once was. Same thing if you go to do a real estate transaction right now. Who's going to give up 3 and 4% to trade in for a 7.5%, 8% mortgage? Just about nobody. The only thing that's going to bring about a pullback in real estate here is if we start to see a real recession set in. We have to see folks forced to sell because the market's getting so bad, they're getting laid off, that they're forced to sell. Otherwise, they're just going to keep on making their payments on their 3 and 4% mortgage. They ain't going anywhere. Even if they don't like the house they're in. Even if they can barely afford the house they're in. It only gets worse if they try to go move to a different place. You get it? Or you become an own nothing, be happy renter, which is not a bad move for a lot of people, by the way. Careful. They want to proceed carefully. Of course. Yes. So cautious. We understand they say carefully. They talk like this because they don't know where we're going. They don't know how much pain they've caused. And it's a game that they're playing here, right? They're squeezing us as much as we can before we break and hit the streets in masses and folks just absolutely lose it. And we're at that breaking point. We're pretty dang close. Some would say that we already are. And the neutral policy rate. Yeah, so once again, they've gotten the rate up so that the cost of your debt's going to be more than inflation. So you have that neutral policy rate is where they're talking about being able to bring it back down, but it'll still be in a line with inflation. We've been covering the data. The real inflation is, 10% plus, 20% plus on anything that matters. I think I just saw one of the countries out of Europe, the price of olive oil in that country is up 25% year over year. It's a simple, stupid example, but it's real. You need that olive oil to cook. It's it's one of the necessities, staples for every household, especially over there. And it's up 25% year over year. And so that's why when we run with these headline numbers that they tout, 2% target, he admits, we don't have a date for when we want to get to 2% by. We don't even really necessarily need to see. We're going to claim victory even before we hit the 2% target, because victory for us is just heading in that direction. Imagine if you ran your business, your life like that. We don't actually need to achieve the goal. We just need to be in the right direction. And we're going to give ourselves unlimited time. Would you ever have real progress? Right? This is fantasy land that the Federal Reserve is in, right? At least what Jerome Powell is talking to us and what the mainstream media is going to run with. And that's why I like to cover this, break it down into simple terms. Here's how it's going to affect you when you run your business. Here's how it's going to affect your investments. Here's how it's going to affect you when you go to the pump to fill up, when you go to the grocery store to feed your family. And every grocery bill is now over $300, isn't it? You can't leave the grocery store without spending $100 just filling up one bag. That's the real inflation. not the 3.7% crap, the cores above 4%. That's all crap. It's a lie. It's a myth. It's fantasy land. And that's what they're living in, and that's what they get Jerome Powell, talking head, to come on here and spout, to cheerlead how good we're doing. Even though he said again and again, they have no idea where we're actually going. We just know that we can paper over this with the numbers and we can hand it off to the White House, and Biden can say, oh, we got the strongest economy. Bidenomics is fantastic. What are you complaining about? You should be cheerleading this economy right along with us. You don't love going to get a second and third job? What do you mean? You're not excited to pay $4,000 a month for a house? $3,000 a month for the median house in America? You're not excited to do that? You're not excited to have your average car payment at $700? Pay $3,000 a month for your mortgage for a little, a little shack now costs you $400,000 in some of these markets, right? You get a little shack in where I live for $400,000. Pay $3,000 a month on that, and then to go get you a little whip, you're going to be at another $700 a month. You're at $4,000 a month just within your car, your insurance, and your mortgage. Doesn't even include keeping the lights on. That's where this is going. And where the heck does that fit into a 3.7% inflation? Are you kidding me? And that's why they exclude housing and energy from the core, the preferred inflation gauge, the one that they're trying to get down to 2%, but they don't have a timeline for when we're going to get to 2%. As long as we're heading in that direction, all is well. And this just confirms what I've been hounding on. And it's not sexy. It's not clickbait. It's nothing that gets folks excited about. But this is the real stuff that we have to understand. They are going to bring more pain. That is for certain. It's just pick your poison. Are we going to get massive inflation? Runaway inflation? Inflation's already bottomed and starting to pick back up. That's been confirmed in the last 2 CPI prints. Okay. GDP is an absolute joke. If you think that we're at 2% growth, what economy are you looking at, right? And the only thing that's growing is that folks are heading back to work. And the only thing that's growing is that we were in a recession last year. No one wanted to call it that, but we hit the technical definition, 2 negative quarters in a row of GDP. Recession definition met, but it was politically incorrect and we didn't want to offend anybody. And the only thing that's happened since is that we've grown because folks are going back to work. They've ran out of PPP money. They might have to pay their student loan debt. So they're saying, oh, gee, maybe I'll actually go back to work. I don't want to have to move back to, to the city to go back to the office, but I'm going to have to. And this is what's underway. And the real estate's going to be lagging. Okay. But the fact that they've said that they're going to keep rates high for longer means that, yeah, these mortgage rates might top out over 10%, right? If we do see them raise one more time, we might do easily 8-9% on your mortgage. And if they, keep them sustained and even talk about raising them more, we could easily go up to 9-10%. Maybe we won't make it that far, okay? But we're already at 7.5%, and we're well on our way to 8% already without another rate increase, right? So this is going to be pain. This is going to be a real estate reset. And you go look at the commercial debt that has to be restructured by next year. It's a lot. It's over $1 trillion. This is not going to be a game. This is not going to be participation trophy for the real estate investors anymore. You better have a serious plan. And we do. And I cannot wait for the deals on real estate. I cannot wait for the deals that we're going to get in business. Right now is your opportunity. This is our time, folks. Let me be very clear. Because we can read through Powell's BS. We can decode what they're trying to tell us, what they're not telling us. But we're able to understand when you look here, they're in consensus that we are not pivoting anytime soon. We are not going to pivot this year. And the expectations for this year was 3 interest rate cuts in 2023. Where have those been at? Nowhere to be seen. Who was somebody that was calling that? Right here. So there's no way. I gave Powell too much credit. I gave the Fed too much credit today saying that they were going to raise another 25 basis points. They didn't. But that's because they don't have a backbone. I mean, look at Powell speak. Now, I want to take a quick look at the markets and let's see how this is impacting, see how markets are reacting right now. Slightly back down for Bitcoin. And the reason why the markets are coming back down is folks are realizing that the pain's going to be here and it's going to be felt for longer. And we ain't going to pivot and pump anytime soon. That's the problem right now, that the markets are, it's a tough pill to swallow for the markets. 27,100 for Bitcoin, 16 for Ethereum and XRP at 51 cents, just under 52 cents for XRP. Let's take a look at Bitcoin. You know, it had moved back up. It had topped out at 27.5 leading up. I warned about this bull trap rally, and we're going to be watching closely. I'm currently not in any trade, but I may be looking at making a move here soon. We take a look here. The summary of the Fed decision, 9/20/23. The Fed decides to pause rate hikes, leaving rates unchanged. 12 Fed officials see one more rate hike. That is the pain. That is the consensus right there. One more rate hike. And like I said, if they really had it in them, it's just like, why are we waiting? Let's just get it over with. Rip off the Band-Aid. 7 Fed officials see no more rate hikes. Okay. And then the Fed sees rate hikes for longer. Yeah. So they're going to keep them elevated for longer. Fed sees inflation at 2.6% in 2024. So they do think that they're going to be able to bring that back down. Okay. And is the Fed pause finally here? The thing about this is a soft pivot, right? A pause is a form of pivot because you're in one direction, which is raising rates, and then you go to pause. It's not a complete 180, right? But it's a soft pivot. If we're getting technical, right, it is a form of pivot. We were on this track. We're pivoting and making a move to go this way, which is pause. Even into the end of 2025, the Fed sees inflation at 2.3% above the 2% target. So, like I said, they're admitting that we're not going to hit the 2% target anytime soon. The goal now, what they're cheerleading now, is that we just start to bring inflation back down and start to approach that 2% target. That's going to be a victory. That's going to be the proper party for Powell is going to be us just moving back down, not necessarily achieving 2%. Whether or not they raise rates again this year is not clear. What is clear is that higher rates for longer is here to stay. I think, to me, it's clear that they will raise. I think it's going to have to be some big, market dynamics that come into play. I mean, if we get a black swan event that crashes the markets, that's the only thing that saves us from getting another rate hike, which in that event, the market would be going through a black swan crash. So, we'd already be crashing. It wouldn't be caused by the Fed raising rates. It would just be whatever black swan they end up hitting us with. That's the only way that we don't get another rate hike this year, right? Continuing on, Fed futures now no longer show rate cuts beginning until September 24. So the market is betting that we're not going to get any rate cuts or the real Fed pivot until September 2024, 1 year from now. To put this into perspective, 3 months ago, futures were expecting 4 rate cuts in 2023. So I was understating. It was actually 4 rate cuts had been priced in. How wrong were those predictions? Yeah. And I've been saying this whole year, the Fed's going to have to continue bringing pain. I know that, financial Twitter, the FinTwit bros want to see stocks pump. They want to keep on seeing NVIDIA pump, right? And everybody wants to see their 401k pump. But pick your poison. What comes with that is massive inflation if we don't raise rates. But the Fed is, not going to be cutting anytime this year, probably not until 2024. And so the prediction from the markets betting that we are going to have 4 rate cuts in 2023, that's looking like there's no chance of that. Now, interest rates are expected to pause for at least 1 year. The Fed has made it clear higher for longer is here to stay. They would rather send us into a recession than risk inflation spiking again. Higher rates are the new normal. Well, no. So we're already in recession. They would rather send us into a recession than risk inflation spiking again. And inflation is going to spike too. See, that's the thing that folks just don't get. No, we're in a recession now, okay? And inflation is spiking again. And pausing doesn't help bring back in inflation. Okay? And if we do send if we do get that Fed pivot, and we start to turn back up, we get inflation coming back along with, okay, your 401k is going to pump again. Your NVIDIA stock's going to pump again. And that's what folks focus on. That's what kids focus on. A lot of younger guys like myself that are into the markets now. All they want to see is that market go up, and that's why they've been begging Daddy Powell for forgiveness all year long. As I've been standing here saying, it ain't coming. It ain't coming, kids. It ain't coming, boys and girls, trying to pump your bags. And for a lot of people, all the way the masses in the whole 401k program, they're complaining, oh, Powell's making it tough on me. I mean, Powell's playing his role. He's just one part of the enemy, of the beast that is bringing pain to the American people. He's just one part of it. There's a lot taking place in D.C. right now. I saw you guys were commenting on the CBDC debate as well. And it's definitely picking up there in D.C. right now. We're going to be watching it closely. Rahul shares new Fed dot plot, rate cuts down 50 to 70 bips versus 85 bits cut expected, higher for longer. That's the consensus, higher for longer. And the U.S. is on course to build more apartments more than ever this year per Rent Cafe. So there's going to be a new all-time high for new apartment units coming in. And this, once again, has all been, a lot of it was financed with rates down much lower. And I think that we're going to see kind of the current wave kind of completed. But if we looked back at the National Association of Home Builders index that came out on Monday, the home builder index is starting to fall back again. And so they know that demand's drying up. We're starting to see a lot of builders offer rate buydowns, permanent rate buydowns. So instead of having to pay 7.5%, they're going to give you a lifetime rate buydown of 4.5% because they don't want to drop prices and they don't want to drop comps. See, when they have a development of hundreds or thousands of homes to sell, and the neighbor down the road sees, wow, the same house that I bought is now $50,000 cheaper 1 month later after I just moved in. My grass hasn't even gotten established yet, and the neighbor's buying for $50,000 cheaper. The builders can't let that happen. That's why they've been doing all the incentives, all the rate buydowns. Now we see the apartment buildings have maxed out, new all-time highs. A ton of new supply that's going to be hitting this market. The other area that we're going to be getting supply from is going to be from cities banning Airbnb. You're starting to see it one after another. These cities are making you get licenses for Airbnbs. They're making you register with them, or they're just outright banning Airbnb like Dallas. And this could bring on a lot of supply. In Dallas, there was thousands of Airbnb listings. And so those now become single family rentals or they become for sale. That brings on plenty of supply along with record amount of multifamily. And if you look also, the single family residential construction in some particular states is at all-time highs as well. This was all done because we have been in a record low supply. We haven't had supply, right? And now nobody wants to sell because they got the golden handcuffs at a 3 and 4% rate. So that's why we had prices go back up so sharply. And, real estate was back up this year, even though the economy around us is on fire and really not doing too well. Real estate was still holding out very strong, very strong. And now it's starting to cool off. It's going to cool off into fall and winter. And we're going to see here, I expect the average mortgage rate, I think, is going to pass 8%. Because once again, folks were thinking that the Fed was going to be cutting 4 times this year. That hasn't been seen. So we're moving off of the 10-year is where the mortgage rates get set from. And usually that's where it's more closely correlated is the mortgage rates with the 10-year treasury. And we've just seen the 10-year treasury go up even higher, breaking above 4% to a level that we haven't seen for well over a decade. Okay. So this situation, folks, getting a little interesting. Bitcoin just dipped below 27,000. It's at 26,950. Gosh darn it. I was actually thinking of getting into a short here. Darn it. I was going to hop off the call here and maybe get in on a short. And it looks like I've already kind of missed some of my opportunity. But we could be coming down much more. Bitcoin right now, it's kind of just been chopping sideways between 25 and that 31K level is what we went up to. That was earlier in July of this year. Okay, 31,000. So not looking good. Bitcoin's back down. More pain for longer, confirmed. As we predicted, we did miss, though. I thought that he was going to have what it took to actually raise rates another 25 basis points this meeting. He took it soft and easy on us, but we're going to be watching, and I'm about to hop on over. We're going to be doing a Discord hangout call right now, and if you guys are looking to get access over there, you just go to my website and you access Discord through the Patreon. We're running a special too right now, by the way. If you sign up for an annual membership, you get to save 13% off your membership fees. And if you want to come in, it's a community of like-minded individuals. I'm about to head on over there. Every Wednesday, we've been having a hangout call hosted by Brenda. Huge shout out to Brenda. And we're going to go chop it up over there in the Discord group. But if you're looking to head on over there, it's at my website, zachrector.com. The link should be down below. And we'd love to have you join us over there. We going to go have ourselves a lunchtime party in the hangout session over in the Discord group. It's all over there at my website. Appreciate you guys on this one. On the way out, if you could smash that thumbs up for me, make sure we're subscribed, hit that notification bell. I should be approaching 70K. We might be at 70K by now, 70,000 subscribers. Let me know in the comments down below, folks. Have we already hit 70K? And we're watching out for the proper party this month. If you guys missed the content, we dropped one this morning. I did another live last night on the pregame party taking place in DC with Ripple, turning up in DC, getting ready for a massive month here of September. I think we got a couple more big announcements coming this way in regards to XRP and the Ripple lawsuit. Be on the lookout for that. And I dropped an update this morning. Did another live session last night. You guys can go check those out. And I'm going to head on over to the Discord group and go hang out with the community. I appreciate all of you guys, and I'll see you in the next one. God bless.